Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 22nd, 2023. It's 11:49 Eastern Time as I'm starting the video, so we have just over 2 hours to go before the much anticipated FOMC rate decision. So we all know that a quarter point's pretty much priced in, baked in the cake, and as I often say, it's not what the Fed does, what they say, it's how the market reacts. And I also go on to say it's not the initial reaction. In fact, there's, from my experience, near about almost 100% certainty, close to it, that that initial, and I'm talking on the 1 minute chart, the little knee jerk reactions you get right away, that's usually faded. And it may or may not be the one that sticks. In other words, you shoot up and then you shoot down, then in other words, just let the dust settle. Don't overreact. I'm going to give you, my thoughts, and we're going to go over a few charts here. Let's start out with this one. We're on the 60-minute chart of the S&P 500. I'm going to show you key levels to watch. So we zoom in nice and tight. There's a busy board here, but I'm going to just take my drawing tool and color up the key levels. So you have this uptrend line I've been highlighting off the mid-December lows right there. Comes in, has quite a few reactions, catches this reaction low there, back tested it from below, and we're a hair above it. It's also Fed day, so for all intents and purposes, we're back testing that now. You could also draw an uptrend line like this off the lows right there, and then this downtrend line right here. So we're back testing. This is a pretty significant trend line. This is off the early February highs right here. You have a lot of reactions, including this one here, to define it, and so that gives limited upside there before significant resistance. I'm going to still take home some swing shorts into the Fed meeting, and I'm willing to give it a little room. Like I said, it's gonna pop or drop one way or the other, and whipsaws are about the only guarantee you get on Fed days. Is you tend to get those violent moves. High frequency trading, those algorithms, those programs jump in there and fire off and exacerbate the moves, and so you're likely to punch through support and resistance. So I'll say this, I threw out a day trade idea today. It hasn't yet panned out. It may not pan out, but we've got 2 hours to go. I think it will. I think we'll see some nervous profit taking before the FOMC meeting. We'll say I'm a little surprised we didn't see the market wanting to send the Fed a message. It just shows there's a lot of confidence in the market now. In other words, I thought we'd see more selling from yesterday and today into that to just make it clear, like the market did back in 2018 in the fourth quarter. The market sent a clear message to the Fed that they didn't want any more rate hikes, and the Fed caved. This time around, I think the market's just pricing in the fact that based on the bank failures lately, that the Fed, at best, going to give the quarter point and then tell you they'll sit and watch and probably bring up their, concerns about the global systemic risk. All right, so that's it. Again, technicals are what I go by, and fundamentals are fun to talk about and factor in. So that's a pretty big level that if we have a solid move, solid close, a day above there, and then the further you get away from there, that certainly ups the case, the near-term bullish case. I'm going to show you a lot of other, not a lot, I'm sorry, this will be a short video. I'm going to focus on those equal weighted indexes I covered lately and talk a little bit about market breadth. So those are the levels to watch. Let me put that trend line there. That's that's SPY, that's SPY on the 60-minute chart. This is what QQQ looks like on the 60-minute chart. Same uptrend line, which to me is a beautiful uptrend line, and one that is so ripe and ready to pop that, again, I'd be surprised if it didn't. So I still have a pretty high degree of confidence. I don't know if we're going to get there before the Fed, but wouldn't surprise me. That'd be a heck of a reversal to happen within the next 2 hours. That'd be almost a 3% fade. So I'm guessing it's probably going to, if we get it, it may have to come after the 2 p.m. announcement. So you decide if you're, if that fits your risk tolerance, whether you want to hold into the Fed meeting or not. I'm going to move this line up just a tad. As I do these videos, sometimes I see reactions right there. You can see these 2 reaction highs, and that one right there, and that one right there. So that's your first support level. So break of the trend line there, and then the BOD line, break under 309.27 should do the trick. Of course, if it wasn't Fed day, that'd be clean and easy. But if this breaks down, let's say today at 1 o'clock, 1:30 p.m., we're right here. Well, the rate decision and then Powell's dog and pony show that starts at 2:30 after the rate decision will certainly impact which way the markets go. But to me, technicals first and foremost, and I still have that same nice clean up trend line. And I have almost a rule. It's not the hardest set rule out there, but it's pretty much a rule that, or again, one that I pretty tightly follow, and the few times I do ignore it, that's usually when I end up getting punished. And that is to be long or looking to close shorts and getting ready to get long on divergent lows. Remember, divergence is not a buy signal, but very often, more often than not, when you have nice, clean, bullish, aka positive divergence, you get a rally, and that was that nice rally there. And then that divergent wasn't the bottom. You had a very tradable rally. This is a swing trading time frame in the 60-minute chart. That was a 5.5% rally, followed by a new marginal new low, which was, as I pointed out at the time, still a divergent low. It just extended the positive AK bullish divergence, and that gave us the rally that we have here. And now we've come full circle, and we have negative divergence. And as I always say, again, divergence is not a sell signal, but what is a sell signal is a break of support. Divergence is a heads up that, hey, the momentum is waning. You had a divergent high right here. You had to see a very comparable, clean, beautiful, well-defined uptrend line, much smaller pattern divergent high, and that gave you a nice tradable correction there as well. All right, so that's it. I don't want to beat a dead horse. I just want to say that the technicals look, today even better than they did a week ago, because now you have on the 60-minute chart of QQQ, you have this divergent high, and you've been building divergence here on the RSI from this point. So that's that 60-minute chart of the futures. Let's go to NQ first, because I been making the case. There seems to be, to me, a very clear, at least my interpretation of it, I believe that a lot of market participants, and I'm sure there's a lot of institutions, feel that for the first time in a long time, or at least in a while, those top heavy market leading stocks, I still collectively refer to as the FANGs, FAAMG. Was a term I came up with years ago after the FANANG, because Netflix was no longer one. But you have to include now the old Facebook, which was the F, is now Meta, of course, so there is no more F. And then you have Meta is actually smaller in market cap and weighting than both Tesla and Nvidia. So it's really, when I refer to those, I'm referring to those top 7 or 8, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta, and Broadcom. Really, those guys make up the bulk of the returns. But I'm going to show you in a second, as I did the other day, they continue to do most of the heavy lifting, and that is typically viewed as unhealthy or non-confirming market internals. Once again, I'll get to that in just a second. But here's my NQ 60-minute chart. So we did have that divergent high the other day. We did hit my first target where I had the arrow break. Expected a reaction. The reaction's carried a little farther than I thought it might, but all it's done is extended that negative divergence right there that we have on the 60-minute chart. So this is the NASDAQ 100, and you can see it's really starting to get a little steeper here, the divergence, meaning prices making higher highs and the indicators really lagging. So yeah, the Fed can certainly swing this either way, and if anything has the potential to override the technicals, it's going to be the Fed. But again, at the end of the day, if I sat here and traded on what I guessed was going to happen, if I went into, if I was trading companies, let's say on earnings, I always say it's a crapshoot unless the technicals are clearly bullish or clearly bearish leading up to an earnings. And then my experience is much, much more often than not, stocks with clearly bullish technicals when they go into earnings, no matter whether they beat expectations or miss, that trend from that point is usually up, and vice versa on the bearish setup. So and then if it's indeterminable, then it's a crapshoot. And same thing with the FOMC meeting. So all right, that's NQ. Again, you guys know my, where I think is going to happen. I think we'll, from now, between now and 2 p.m., start to go on to break this trend line, and then start to move lower. And I give you a little minor support level on QQQ, which I'll give it to you right now on NQ for you NQ traders. You can see these two reactions here. Let's just tighten up real quick. Come in here. You see a little reaction high there, another reaction high there, reaction low there. So there's your BOD, or benefit of the doubt line right there, 12, 8, 11. And then whatever, that should be what follows today, or in the coming days to weeks. Okay, couple more things. Told you I'd give you a few more charts. Let me show you this. I find this interesting. So let's start out with the market, or at least the market is viewed by the S&P 500. First, let me tell you, I made a post in the comments section. I'm watching market internals. Remember, I did a whole video the other day on market internals, so I'm not going to get into that again. That took forever. I'm had a watch list here. I'm trying to drag over for you. There we go. Okay, what you're looking at here, these are the sectors in the S&P 500. So SPY just turned negative. We were up. But it just turned negative, and QQQ is still clearly positive by about 0.5%. And you can see here, of the 11 sectors in the S&P 500, all of them are red except XLP, and that's consumer staples. Those are the ones institutions go to buy their defensive issues. Staples are things you need, like toilet paper and toothpaste and shampoo and stuff like that. So they tend to do well in a recession, or at least outperform in a recession. Because you still need to buy those items. Tech is typically more dependent on the economy, and you can see it's the only thing holding the market up right now, or not. Well, I'm sorry. Well, today. And look at that. Look at that big divergence on XLK. And so I think there is a misguided placement right now into those big market leaders, because they are cash flush and have a lot of them have big stock buyback programs going. I think that's a dangerously misplaced a safe flight to safety bid, or at least you call it what you want, but I can show you factually, and I have in the recent video, with the market internals deteriorating. But let's do this. Let me just, okay, so I just showed you, of the 11 sectors in the S&P 500, only 2 are positive, and by far and large, the one that's doing almost all, resulting in all the returns in both the NASDAQ and the S&P today, is XLK, up 0.71%. So we look at QQQ. As I type, it's up 0.36%. It's come off the highs a little bit, but not much. Now, all you have to do, this is simple stuff. When you want to kind of check on internals, I always say one day doesn't make a trend, so be careful there. But again, I've pointed out the trend lately, and the trend continues today. So 0.35 as I type on QQQ. Now I'm going to enter QQQE, and we're down a quarter point, negative 0.26. And so this is the NASDAQ 100, the same basket of stocks, but just you apply equal weighting. So what does that tell me? Everything I just told you, that it's a few stocks doing all the heavy lifting. You can also see the same thing in SPY. SPY doesn't have as much of an impact. Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta, they are also the top holdings in the S&P 500. It is also a market cap weighted index, so they have a higher weighting, but not nearly the impact the NASDAQ 100. So we're flattish. We were just positive when I started the video. We're down 0.04. We'll call that flat. And then you just type in RSP. That's the equal weighted S&P 500. You can see that's down 0.52. You want some additional evidence, go like this. Pull up. Here, I'll do it on SPY. And click on the component list, and I've shared with you guys my real-time market breadth indicator, and what you do there. I'll try to fit it all on the screen. There's 500. It says 501 items. Remember, some companies have different share class, like Alphabet, for example, 2 different share classes, but it's the same company. So I go like this. I sort by percentage gainers or losers. I scroll down to the bottom to where they go red. So we're flat in the S&P 500. I'm going to split the difference here. It's changing in real time, so we're right about here. And that tells me on the bottom that you probably can't see in the video, but it says 160. So I click down on the top. 160 stocks out of 500 are trading positive, and that means the rest are trading negative and with a flat S&P. So there it shows you that is bad market internals. And same thing, you can do it with QQQ. You have 100 stocks there. So click here, go down, scroll down to the, oh, no, let's do it the other way. Okay, put the gainers up top and click on the last one, Micron, and it tells me that even though the S&P or the NASDAQ 100 is up by 0.5%, only 36, 1/3 of the stocks in there are trading positive. And you can see the ones that are your usual suspects. There it is, NVIDIA, AMD, Microsoft, so on, you know. You have big tech there. There's Meta, there's Alphabet, right? Apple. So there it is. All right, and again, one day doesn't make a trend, but it is several days strung together, and even several weeks, which we've seen, does make a trend. And so, you know, just like I always say, divergences are not a buy or sell signal, whether they're positive or negative divergences. Just as I always say that overbought and oversold are not buy and sell signals, neither is negative breadth or market internals, deteriorating market internals. They are conditions, and they are conditions that can continue to build, just like your health. If you got a health issue, you know, it doesn't mean you're going to die or get sick right away, or, you know, but the longer those issues, you know, occur, the more likely it is to happen if you don't fix it or if they don't get rectified. So, you know, these things are not immutable forces, meaning that breadth deterioration doesn't always result in a correction or a bear market. Just more often than not they do, just like the divergences, just like the overbought and oversold conditions. Okay, so that's that. Made that pretty clear. And then RSP, let's just keep focus on these equal weighted. You know, I've showed you how repeatedly how the S&P 500 is currently back testing. Here, let me start there. For those of you catching up, I have a clean board here somewhere. There it is, my clean, even cleaner board. We'll use this one. Yeah, I'll use this one, doesn't matter, same thing, because this one has the yellow line is the primary bear market downtrend line. There's the all-time highs and the last bull market in the S&P 500, and it's a beautiful trend line. Beautiful because it has a lot of clean, distinct, major reaction highs on it with rejections, and then we had a solid breakout, successful back test. We failed the back test. Now we went back above it, but we're still we're chopping around. We're in close proximity. We're not, when we start walking away, when we take out this high, then you're going to say, I can say with confidence that was a successful back test. When we take out this low to the downside, I'll be able to say with confidence that was a false breakout, aka bull trap, and it has failed. As I told you before, even before we failed it, I said, look, it's not binary, it's not all or none. If you go down below there, I said it's incremental. The farther you get away from that level, and you do always have to take out those previous reaction lows. And so far, and I maintain we need to take out, that's Monday before last, we need to take out that candle right there low. And you can see there's a nice clean downtrend line to take out there. Also, you're right on the 200-day moving average right now. The 200 days, whether it's sometimes it's a simple, sometimes it's the exponential moving average. That's the blue and red lines. They often cap advances. So again, this is just one big sloppy battle, if you will, between bulls and bears, and it's going to be resolved one way or the other sooner than later. Bulls win here, bears win there. Let's not overthink it. Now let's look at the equal weighted S&P 500 RSP. Again, this is telling a different story. When you look at the overall, if you want to know what the stock market's doing, you look at the Wilshire 500, or you can look at the equal weighted S&P is probably your next best thing, because that's showing you 500 companies diversified among various sectors in the economy, much more representative of the overall stock market and the overall economy than the NASDAQ 100, which is just a concentrated tech-heavy portfolio, excluding key sectors like financials and things. And you can see here 1, 2, 3, 4, 5, 6 clean reactions. You see the equal weighted breaking out like the S&P 500 did above its primary downtrend line. You can see it coming and back testing it, trying to rally, and a clear, unmistakable failure. Also recently undercutting those previous lows, and we're right there right now. So if you want to look at the, use this as a measure Again, I'm sitting here, I'm supporting a bearish case. I could all day long in these videos go for 2 hours instead of 30, 40 minutes. I could sit here and tell you everything bullish going on right now, and there are some things bullish. And I do usually highlight the key ones, but as of now, like I said, this is telling me, and these are things I just think that most folks, when I do watch CNBC or read, the articles in there, a lot of the pundits don't talk about these things. I try to, you know me, that's why these videos go so long. I look at a tremendous amount of charts, and I'm not always covering everything I'm looking at. You did have some divergence there at the low and all that. So I just want to point out that the stock market as a whole isn't doing as well as they talk about on Bloomberg TV and CNBC, and the people coming out citing the S&P 500 or the NASDAQ 100. And we can do the same thing with the NASDAQ 100. The NASDAQ 100 certainly looks good from this perspective. I have two downtrend lines. I have a primary right there, and that's really the preferred trend line. You have the initial high, 1, 2, 3, 4, and then a breakout and a successful back test. And right now you're testing that previous high. So by that, and you're well above the 200 days. So I'm going to give this points. This gets, the bulls get a check mark for this. However, again, this is sort of an illusion, if you will, because this isn't all of the NASDAQ 100. This is just a handful of those big, I don't want to call them bloated, but they are very top-heavy components, the Apples and the Microsofts and Alphabets and Amazons. And that's what I was most bullish and long right here, catching most of that initial leg up. I just think that that's it. I think it was a bear market rally. And again, I think we are heading into recession that's going to be longer and more powerful than any in recent history, going back probably the past century or so, half century, I'm sorry. And therefore, the big tech will get dragged down with it. So it's, in my opinion, a sucker's rally as of now, despite this look. And then all we have to do now is just throw in the E at the end, QQQE, and let's see what that's telling us. Okay, so here's my QQQE. If you give every component in the NASDAQ 100 an equal weighting, there's your all-time high right there from November of 2021. And that's probably the best fit. Let me pull it down a little bit. You can come in, capture those two highs. You could do that, have a spike. This would be the best fit trend line I can come up with for the downtrend line there. And you can also see, if I turn off all the lines here, you're in much closer proximity, like I like to say, within spitting distance, or one bad day of being down. One good 2-3% down day, you have the 200-day exponential. So what you're doing is you're bouncing. You just bounce off the 200 simple, and you're just a hair above the exponential. You've been testing it. And again, those two moving averages are very key in bull and bear markets, have been for decades now. I've covered that many times. You failed here right between the two. You split the crosshairs between the 200 simple, the exponential, the red line, and the 200 simple. You were in a bull market here, so you were above them. They acted as support. Yeah, and then you had the last successful bounce off support, and then you clearly took them both out here. And since then, they've acted as resistance. So and I've done this too in the past. I've looked at the previous bear markets. There's usually that point where you do come up and either test them or briefly take them out. And again, I just want to say it's anybody's game right now, bulls or bears. Oh, I was trying to draw that line and it just repopulated. So there's your uptrend line, by the way, for the NASDAQ 100 equal weight right there. So we're going to watch that one. And yeah, guys, I think the good news is we'll know within the next week or so here. This Fed meeting has a potential to break us out of this kind of what I call Mexican standoff between the bulls and the bears, this little battle here for key technical grounds. And like I said, overall, you have a lot of the S&P, the NASDAQ 100 above the 200, so I think it's ripe. I can understand why many are bullish, why many are calling for the bear market to be over, why many are calling for a much larger rally. I just dig a little deeper under the hood and I look at those things like I just covered, breadth indicators, equal weighted indexes, and things like that. And the last thing, and I'll leave it on this final note, if we are going to get that next leg down that goes to hit my next target. So far, called it down to 1, 2, 3. Hit all 3 of my 4 initial bear market targets. I'm still calling for a one more leg down in the bear minimum. I think just till we get a nice rally next. A rally that could even last longer than the ones that we've had so far. If we are going to get that, you know what you need to get that final capitulation type selling where the VIX spikes to extremes and the put call ratios hit those extreme measures, and I've given you all my breadth indicators the other day. The video I did, I showed you the percent of stocks trading above their 200-day moving average and all the other indicators that I had. Beautiful what I call bear market or endpoints where we've hit in the past that we didn't hit yet. To get to that, what it takes the masses to believe that we're not going to do that. Only then can you have to clear out enough short interest and suck in enough new cash, new money back into those longs to set that stage, because the market doesn't fall hard and take those final capitulation type sell-off legs down until you've kind of cleared out a lot of short interest. That's usually what needs to set the stage. So again, I may be wrong, and I see the current near-term trend, and I see the comments on the site, and I know a lot think that that we're going to continue higher after the Fed. I've read, I've seen not all, but a lot of those comments that it's baked in the cake. There's nothing we can do but go up because if the Fed's going to give us 25 basis points, and at that point there's nothing bearish left. Maybe, but again, I'm right now trading it the other way, and I'm going to give it a little room. I gave you this chart here. The last time I highlighted the VIX as backtesting that trend line was right here. There's an objective long entry. If you took it, I can't grab here because then I move that line. So what I'm going to do is measure from here a little bit above that point up to a little bit above. From a little bit above where it backtested the first time, and then take that above there. That was about a 25% rally. And so it's either going to work out or not. In the post I gave you 2 stop levels. One would be about there, one would be about there. You have nice support there, second support there. So that was, that's the buy zone from anywhere from right here on the back test down to, but not below S2. That means second support. And, stops are where in line with what you're targeting. If my suspicions are correct, and I told you it was a moonshot trade because the odds are highly against it. When you call for pretty much a crash in the markets as strong as it is now, and a lot of the, when you're above the 200 days, that is an extremely contrarian call. And so again, I try to always tell you that I look at things in two things I look at on a trade. Is the probability of success, and this one I'll have to say it's below average, well below average, but then the upside potential if correct. And so if everyone's thinking the market's going to explode and the VIX is going to melt down, but we go the other way and the market drops down, that's where you see a sudden an imbalance in put to call buying, and that's what the VIX is calculated on. So anywho, take it, don't take it. In fact, I encourage, from reading the comments, I can't tell anyone what to do. I cannot give advice, but I encourage anyone, if you don't know what to do or you think otherwise, then the market's going to go one way or the other, or any trade, don't take it, especially right now with the Fed coming up. There's nothing wrong with sitting in cash, and there's nothing wrong with being long. Just manage your stops appropriately. And I'm going to wrap it up here. We'll see where the day goes. And like I said, it's not the initial reaction. I'm going to give my swing shorts a little room. Might get smoked after the Fed, and I'll certainly give you an update. You'll get an update from me before the market closes today on what my thoughts are and what I'm doing, and I'll let you guys figure out what you're going to do there. So as we go to wrap it up here, I think we've now triggered close, not yet. I see a little reversal in NQ. But we're not yet below the trend line, getting very close. And like I said, I already gave you these levels, 12, 8, 11, minimum target, and now it's looking like it may take till after 2 p.m. Maybe that gives that initial spike down, and again, that's just a minimum target. And the trade idea setup I gave you this morning, with an add-on to come or a sell signal, if you want to wait for it on the break of that trend line, you can always, if you get it, set your stops. One strategy, if it starts to pan out and NQ is moving down here, at some point very shortly thereafter, you put a stop at least at break even. That way you lose zero. If the NQ reverses, trades around the clock, it's going to do so, up until we close on Friday. So you have almost a zero chance of loss if it starts to play out. And then let's say you take out 12, 6, 12, and you start going down to the new one. Then you can set a stop a little bit above there, because that was support. Support once broken becomes resistance. So give yourself, and just remember too, if you're trading around Fed day, whether you're bullish or bearish, my preference is to if you're actively trading or day trading, especially if you're going to hold into the 2 p.m. meeting, take smaller position sizes, because the gain in profit loss potential are a lot higher. And also a strategy I'll do is you're going to have to give it a little bit wider stops, or you're going to get clipped out in the noise. You'll see what I mean by the noise. Come 2 p.m. the market's going to do this. It's going to shoot up, and may continue to do that after Powell starts talking at 2:30. And so if you're running a 0.5% stop on an NQ position, you might as well just turn it over to them. They're going to take it. Like I said, that's just trading 101. Is when volatility is high, or you're in a security that has a lot of volatility. It has more profit potential, but also more loss potential. But the strategy to stick with the trade, if the charts are confirming, is to give it a little bit more room on your stops. And then because of that, if I'm allowing wider stops, I then take my position size down, so I'm not also taking an oversized dollar loss. To me, losses percentage is irrelevant. It's dollar amount. So I kind of factor that in as well. All right, I will stop it here, get the video out to you guys, and we'll pick it up either after the Fed. If I see anything else compelling before the Fed, I'll let you know. I already given you pretty much all the new trade ideas and updates today. ZB, you could have gamed that. Can we hit that target there? ZN, same thing. And so that's something else you want to get out of. ZB, we're almost to that bounce target I gave you, 130.40. If you did cover and reverse there, no reason to hold that going into the Fed. The risk reward is just not worth it on that, at least my opinion. So that's it. I'm out. All right, guys, I'm wrapping it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.